Welcome to ETM Analytics' first take of the markets. I'm joined by Director George Glynos. George, Nikkei is red, Seng is red. We're expecting this red to continue flashing as the markets open across the globe. It's been a bloodbath following the wave of Trump tariffs that they introduced last week. It's not a pretty sight.
No, not a pretty sight. And as I'm looking at the screen right now, I see Hang Seng down 12% in a day, and Shanghai down nearly 8%, and Nikkei down nearly 8%. So yeah, it's a bloodbath, and it's a very aggressive sell-off in a very short space of time. I tend to find, and just my experience, trying not to show my years here, but my experience tends to tell me that when the sell-off becomes this aggressive, the good news is that it doesn't last particularly long, because it forces a lot of hands in a very short space of time. And whose hands am I talking about specifically? Well, it might be on the fiscal front. A lot of countries will consider stimulating rather than austerity. We'll wait and see how the Trump administration responds to this. Equally, central banks are likely to respond, because you must appreciate that when you get sell-offs this aggressive, it tends to result in some big losses being taken all over the show. If there is a big unwind in speculative positions, maybe from the hedge funds, for example, it tends to impact the liquidity in the market. And as that liquidity impacts, so the central banks will try to respond to that by liquefying the market. There are very few ways that they can do that, but the obvious ones are rethinking and reigniting the QE printing presses and looking at rate cuts. So we think that there's going to be a lot of discussion and talk and speculation around that through the course of this week. I don't know how quickly the central banks respond, but they will be wanting to try and keep asset prices from deflating too aggressively, because it will undermine their efforts to keep an economy growing. It will undermine the stability of financial markets and destroy any sentiment. So I think it's safe to say that the risk of recession has ramped up very significantly this morning to an almost dead cert. And the extent to which these foreign countries respond to these tariffs, I think, is going to be the key as to whether this goes a lot deeper, or whether it's just something that blows over pretty quickly. So, this is the situation that we find ourselves in. It's an ugly picture right now, and it's going to depend on two things: how countries respond in terms of their tariffs. Are they all going to respond like China did and smack the US back with tariffs and restrictions? Or are they going to call the US's bluff and say, okay, fine, you want reciprocal, you talk about reciprocal tariffs, let's drop our tariffs to zero and see how you respond. Now that would be very constructive. If the tariffs were reduced to zero and the Trump administration responded, this will reverse very, very quickly. If that's not the way that the global policymakers respond, then I think this can get a lot uglier. A lot uglier. Let's just put it that way. So, we're all waiting to see what the response function is going to be, but that is going to determine whether we sell off another 10, 15%, or whether, we start reaching for a bottom soon.
And we see countries do that. Perhaps not as noteworthy, but Zimbabwe's Emerson Mnangagwa came out and said, we'll reduce all our tariffs back to zero, in an attempt to kind of build a new relationship with Trump. We know the US and Zimbabwe ain't exactly friends, and they haven't been for a long time, but we see these countries, and the same goes to the DRC and their ongoing discussions with the US administration to find a deal. So you kind of seeing both of these elements playing out of countries like China and the likes perhaps kicking in their heels. You're seeing countries realizing the risk and they're approaching the US. My interest, where I think it's going to be an interesting dynamic playing out, is your more central parties and perhaps more Western allies and how they're going to respond. The EU in particular is going to be one to watch, whether or not they're going to kick in their heels or start understanding, like you said, you can entrench this trade war. You can make it a lot more painful. You can make it a lot longer if you kick in your heels. And I don't know which way these leaders will turn? Are they going to see Trump, continue seeing him as a bully and trying to stand up to him? Or are they going to go, okay, let's go back to the negotiation table and try and end this?
Yeah, I mean, it's at this point, leveling counter tariffs also almost seems to be a case of cutting off your nose to spite your face.
Exactly.
It's not necessarily the best solution. If you want to adopt a more constructive approach to all of this, like I said, the easiest thing to do is just take the wind out of the sails of the Trump administration, and that is fine. You don't want tariffs, we will remove all tariffs, but then we would request that you do the same. Trump would probably see that as a victory, and it would give him an off ramp out of this position that he's in. So he could turn around and say, "Yeah, absolutely. If you're going to zero tariff us, then we'll do the same." If he does that, then then like I said, this can turn very constructive. But it's the big egos in the room at the moment, and it's questionable whether they will adopt that more constructive approach. I'm not so sure that they will, at least not for a little while. But I do believe that the market is going to respond quite negatively to any country that decides to engage further in the trade war. So any country that wishes to engage further, I think, is going to find themselves on the receiving end of some negative feedback, just because they will have exacerbated or extended or deepened the current mood, which is obviously something we're all going to want to avoid as much as possible.
You mentioned the central banks now in your earlier response. I just quickly want to return to that as a last question. We know that the Fed has been busy with some quantitative tightening measures in the background to drain some of the liquidity they pushed into the markets following the pandemic, or during the pandemic, actually. Could this sell-off that we're seeing perhaps, push them to stop such measures, at least for the interim, as they're trying to just kind of protect what's going on in the economy?
I think there's a good chance that they do. So just remember, the US at the moment is dealing with a bit of a trifecta. They are looking to tighten fiscal policy significantly. I mean, the Doge team was talking about trying to trim government expenditure by $1 trillion by the middle of the year, and that is that's not just austerity. That is full blown recessionary type stuff. At least in the beginning. He's then obviously conducting tariffs, which is another growth headwind. And the third thing is trying to shrink, which I guess is linked to the first, but trying to shrink the size of the civil service. So you should expect the labor market numbers to turn ugly pretty quickly. You will find that the combination of the tariffs as well as the aggressive reductions in government expenditure are going to impact growth quite negatively as well. So the combination of all of that naturally is going to increase the chances of recession significantly, and I think the Fed will respond to that. They won't want this to become a runaway train. They do not want to see stock markets plunge too far. And so the minute that starts to happen, it undermines one of their mandates, and one of their mandates is full employment. So, the Fed is probably going to shift towards prioritizing a GDP growth over inflation. At least that's what I would expect them to do. And if they're going to do that, well, then you would expect them to talk a much softer, easier game. Although they do have a bit of a headache at the moment because they're not close enough to their inflation target. So it's a bit of a dilemma, but they'll probably frame it in the sense that, well, if we're going into recessionary conditions, inflation is no longer anticipated to last particularly long. So we will prioritize growth instead.
We know obviously domestic politics is also making some background noise, but against what's happening, it's really minuscule at the moment. It's all Trump, it's all tariffs. Hold on to your hats. I think that's the message right now. But George, we will catch up again next week then.
Thank you.